Welcome to another Dolphin Financial Radio, everyone. Today we're going to be talking about inflation yet again. I know we've done so many shows on inflation that it's almost becoming way out of whack. But today we're going to be talking about a study that I came across that said inflation is causing a majority of Americans to stop or reduce retirement savings. And this got me a little upset. So I wanted to talk about it. And because I was upset, I invited my friend and co-host Tony Short along to calm me down. Tony, welcome to the show. We've done how many shows on inflation? It's going up as fast as inflation out the top, it seems.
Yeah, we've
will
done.
it ever stop?
Yeah, our shows on inflation have increased more in the past year than inflation itself, and that's saying something, right? I mean, you have to cover it because it's what everybody is talking about, and it's affecting so many people, and it really affects our listeners' finances. And I know, Dan, you like to be educate our listeners as far as helping them overcome issues like inflation and avoid mistakes with their finances. So obviously we need to talk about it. And, there's a lot to talk about, though, right now. The Fed raised interest rates again to try to quell inflation, but that pushes us further toward or into, depending on your view, recession. So they're trying to slow down the economy, but that also causes recession. So we're walking the razor's edge right now with all this inflation and everything else, aren't we?
And it's causing some people, at least from my perspective, to make some mistakes.
Yeah.
And that's what this is suggesting, that people are stopping or reducing retirement savings, which isn't a good thing.
No.
This is a survey that Allianz put out, and October 26, 2022 is when they released this. And there's the link for those that are watching on YouTube. It's a short press release, and I have not read the full study, but I'm going to go over some highlights that I saw and talk about how these people are, or maybe why it's happening, and maybe why they shouldn't or should do what they're doing.
Right.
Just a quick note, Tony. This was a sample of about 1,000 respondents age 18 and older. Okay.
Oh, okay.
So we do a lot of discussions on retirement planning here. And most of my clients are late 50s.
And 50 older. Plus, right?
Yeah. So there are people and generations that are answering this survey that aren't necessarily who I serve, but it's important because it's about retirement planning. So let's get into the first stat, Tony. Here's the killer. 54% of Americans say they have stopped or reduced retirement savings due to inflation.
Wow.
Yeah. Now, if you're already retired watching the show, which is probably a lot of people or close to it, this is something that you might say, well, I'm reducing my retirement savings because I'm in retirement, but I don't have savings anymore. I have spendings. Are you reducing your spending due to inflation? Or reducing, I shouldn't say that. Obviously, your inflation is causing you to increase your spending on the same things that you did. So is your lifestyle decreasing because of inflation? That's a bigger question. But in general, what's happening is people are reducing their savings. And here's the other one that really bothers me. 43% say they have to dip into their retirement savings.
Ouch.
Because of rising inflation.
Really? That surprises me.
So now let's analyze this for a moment. So dip into retirement savings can mean a lot of things. I'm hoping it does not mean that people are rating their 401k to live, because that's a problem. But they're talking about retirement savings. So this could be someone just saving money in their savings account at the bank that's earmarked for retirement.
Yeah, but nowadays, most people, when they refer to retirement savings, mean a 401k or an IRA or a 403b.
Right.
some type of specific retirement account. And that's
Right.
really bad because they may be, depending on their age, paying a penalty, I would
That's
assume,
right.
for taking that
Yes.
out.
An early withdrawal penalty of 10% if you're below 59 and a half. There are some hardship exemptions, but
Inflation isn't one of them. Inflation isn't a hardship exemption.
No,
Although
inflation's not a hardship.
it should be this year. But what I think is probably happening, Dan, is they're taking that money out, and the problem with doing that, there's a number of problems. Obviously, you have less in retirement, but you're missing out on the compounding interest that would be
Yes.
there, and you're probably paying a penalty. But the biggest is, if they're doing it right now, this in 2022, they're paying, they're pulling it out when the market's down, right?
Right. Most likely in the market, but we'll
Yeah.
get to that in a moment. What this says to me, and I'm going to assume with you, I think most people refer to their 401k or formal IRA retirement savings when they're talking about this. I can only guess, but even still, just 54% reducing. So let's just talk about that. Half of the people are saying, instead of contributing 5% of my paycheck, I'm going to do 4 or 3.
Or none for a while.
They're not getting the match anymore.
Yeah.
So there's, what this says to me though, is that people are still living paycheck to paycheck. We did a show, it's got to be almost 2 years now, I'll put it up here, where we talked about what people were doing with the stimulus money, what people were doing when they were not going out because COVID was around, and savings increased dramatically at that point. Are people tapping into those now, just now, because of inflation? Or are we something a little bigger? And what this says to me, which is a big problem in our country, is people are living paycheck to paycheck. And if you're doing that, you are going to feel the pain of inflation because your paycheck hasn't gone up necessarily as much as inflation, right? I just saw in Florida, where I'm at, in the county, Pinellas County, I think the teachers got like a 4.5% raise, which, that's a lot. If you think about it traditionally.
Yeah.
But still not enough, in my opinion,
not so much this year.
Inflation, no. Right? So if you're living, and I see articles all the time, how a married couple making 200,000 is living paycheck to paycheck. People are living paycheck to paycheck. So it doesn't matter how much money you make. Inflation impacts everybody across the board. And if you're living paycheck to paycheck, it doesn't matter how much money you make, because you're going to feel the pain. You're going to be like, oh, I got to cut somewhere. And the first place to go is savings, particularly for retirement savings, because you're not going to see that money until 20 years down the road. And again, delayed gratification is not something that we're good at.
Nope. We are not good at that. Here in America, delayed gratification doesn't work out so well.
Yeah.
Not so much.
So going back to the Allianz study, 75% say they are worried about the rising cost of living and how it'll affect their retirement plans. So people are thinking now, okay, especially I bet you those closer to retirement, well, I had thought that I was going to retire in 2 years, and maybe they have a retirement planner, which would be great. And they say, well, here's how much I might need and how I'm going to invest. And, but they're like, wait, how much is food going to cost? Like, I wasn't expecting to have to allocate so much money to basic living expenses. Now I have to raise that, which means now I have to save more. So people are getting it. And this makes sense to me.
Yeah, exactly. I think that it's weird, though, that people would, I get it, like you feel a pinch, but it's too bad that people would be in a position where they feel they have to take money out of a retirement account before they're retired or before they need it in retirement. And that's what 9% inflation will do, I guess. And it's over 9% in some areas. I mean, if you look at certain groceries are crazy right now.
Well,
it's like,
right.
and
Airfare.
what they're, Yeah,
is up like
airfare,
40 or
groceries.
50% year a
Yep.
year. But okay, you're surprised that people go there. I'm not, because that's the first to go. It's like, if I can reduce. So I'm hoping people aren't reducing their retirement contributions, because you have to actually manually go and say, instead of giving this much, I'm giving that. But I could see people doing that, and then their paycheck is up. But I think that people are just, it's easy to put that on the back burner. I'll do that next year. Right now, I got to live. I think people are doing that more so than saying, I'm going to eliminate some of my excessive spending, which is what people do. I think people spend too much in this country, and it's the delayed gratification thing. But
and we're all guilty. Most of us are guilty of that.
But when you see this cost of living increase, and you're like, wow, look how much that does. That's amazing. People starting to say, well, I have to make this much just to keep up. And then they're starting to say, oh, I see the power. They see the power of compounding interest when it's working against them, much more than they see when it's working for them, because it's a slower burn. Whereas when you have something parabolic like we're going through, retirement is about income. And so inflation increases the income need just to maintain your standard of living. So what do? Do you decrease your standard of living, or do you just stop saving for the future standard of living? And we just did a show recently. We called it, I think it was, it was an article about how you shouldn't save for retirement. It doesn't make sense. And it's the same concept. It's like, of course you shouldn't save for retirement, because you're living for the moment. But
that's not right. But Dan, as a financial advisor, if you're a good financial advisor out there, you are helping people, your clients, come up with a plan that has included for their retirement income. You include or factor in inflation, right, over the years, and what they're going to need. That's a factor in figuring out what they need saved for their retirement income to make it last. However, even the best financial advisors like yourself, I don't think anybody was planning on, 9% this year, but you do a higher percent. I know some may factor in 5% a year, even, and so
that's a lot. And you're right. Some people don't factor in inflation at all, which is the big mistake.
Yeah.
But it's really hard just to figure out what you need, let alone add an inflation factor. Once you start adding inflation factors, no one's going to be. If you put 9%, in perpetuity, no one would retire ever. Right? It would just be like, and then I would agree. Why bother saving? Just
So now I need at least $20 million to retire. So let me check. Let me quick check my my radio show co-host bank account. Oh yeah, no.
Well, it's more about being reasonable with inflation. So you can't expect this to continue. If we do, then what are we in Venezuela? It's
You're right.
So, but it could happen. And that's really difficult to combat against. But the only way to really combat against super inflation for extended periods of time is to increase your wages. And that's easier said than done for a lot of people. But you have to stay invested in something that will keep up with inflation over time. And looking at the bond market and the stock market in 2022, they've gotten crushed. So you feel the pain even more. Well, why bother saving if I'm just going to lose 20% in a year? I feel cheated. So granted, inflation's 10%. I just lost 20. So I'm really down 30 if you think about it, or more. People get discouraged and then they run away. But that's the thing you shouldn't do, especially when you're younger and you have time on your side. 71% from this survey, 71% say keeping some money out of the market to protect it from loss. And that's been increasing. So this makes sense. As the market crashes, people start to pull out because they're scared, particularly the boomers. But this, if you look at the details on this, the younger generations are also even more afraid of the market.
They're keeping money out, not necessarily. This doesn't say they're necessarily pulling money out, but the majority of the older people that all their retirement savings is attached to the market because it's in a 401k or IRA, probably. they would be pulling money out. But some people have money sitting on the sidelines, or if you're wealthy, you might have, I mean, some people have a bank account with $1 million in it. So
Right.
it's never been in the market. But the smart thing is to put it into something that makes interest, but protects the principal at least. And so
Well,
there are
yes.
that for some people that works. And I'll tell you, Dan, now I'm amazed at some of the things because of the year we've had and the progression we've had over the last few years. I'm amazed at how far some of the products have come, even some stock market, buffered index portfolios and from investment companies.
Yeah. Yeah.
And that's from the investment side. From the insurance side, you've seen these, to combat the interest rates at the banks, which are low still. They have MIGAs, or multi-year guaranteed annuities, that are paying anywhere between 3 and 5 or 6%.
Right.
And that's more than you can get out of a CD. So it depends. And, obviously liquidity comes into it, but they really are making changes, trying to get, because money flow is stopped,
Well,
and the stock
exactly.
market
And
is
we just did the show
investors.
last week. Our
Yeah.
last show was on why are people buying annuities? And
Yeah.
I might add that this study is from Allianz, which is one of the largest, I think maybe the largest money manager in the world,
Yeah.
out of Germany. But they have a huge presence in the insurance world. Of course, their solution and some of the commentary from the author, the company was, what the answer to this is to buy an annuity with an inflation adjustment, something or other. And
Yeah.
I'm not suggesting that's the answer here, but people are scared. Look at this. More than 2/3 of Americans, 67%, say they are nervous about investing. But here's a biggie, Tony. They don't want to miss out on a recovery because people know about that. They got burned in 08 because what happened was it was so painful that people pulled out of the market. And like you mentioned earlier, then they missed the upside.
They missed the upside, which is coming. I mean, you have a year like 2020, the market, at least in the past, and this doesn't necessarily mean it's going to happen in the future, but for the 100 plus years the market has existed, or hundreds of years, it's always gone up. And especially over the last 20, 30 years, when we have a big drop like this, it goes up exponentially and usually sets new highs, new records,
Exactly.
right? Yeah.
Exactly. So let's imagine this for a moment. If you're 60 versus 30, huge difference. Okay.
Yeah.
If you're planning to retire in the next 5 years, then maybe a 5-year MIGA or 5-year fixed rate CD, something makes sense. All right, give me my 5% for 5 years. But for a 30-year-old to go and do that because they're afraid of the market, they're not guaranteeing, but they're really putting a very reasonable, very high chance that they'll miss out on a recovery because they're sitting in a fixed rate or in cash. And so the question I have when I'm looking at this is they're nervous, but they don't want to miss out on recovery, which is a good thing because recoveries can be parabolic, like you said. But are people trying to time the market? Is that what's happening here? I don't know. Look at I'm going to unmute Tony because
that's not good.
People are trying to time the market, I think.
I had to mute myself because my comments weren't appropriate because we're talking about how bad the market's been. So I had to use some words.
Big gasp.
But we're talking about inflation.
Inflation, increased taxation.
Uh-oh.
That's inflation for you.
Yeah. So, do we see inflation continuing? Who knows? And I mean, the Fed is doing everything they can to try and reduce this. Are we going to go into a recession? Yeah. And then maybe that's when you buy the stock market. Timing the market is such a difficult thing to do.
Yeah.
Even as a money manager, I find it not repulsive, but it's just, it makes me shake to try and think. If someone comes to me and says, when are we going to hit the bottom? I say, go talk to someone else because I'm just not going to pick it. I can't catch.
Nobody has a crystal ball,
But what I will say is, and we've done shows on this in the past, and my philosophy is you have it. If you're 60, let's say you're 60, and I just use the 60 versus a 30-year-old, does a 30-year-old should get a fixed rate? No, maybe on some small cash that they might need for a down payment on a house in a couple of years. But for the long term, the stock market's the place to be. Can I say the same for a 60-year-old? Yes, because a 60-year-old has a reasonable chance to live 20 plus years, right? So they do have some longevity on but not for everything.
Right.
Because a 60-year-old's probably going to need income, and you don't want to have income at risk. So you want to partition your income and your assets to generate income from what you need, but also, hey, 20 years from now, I might need, because what's inflation going to be then? I might need some extra money. So why put that into something safe or fixed when you can let that roll through a 10 or 15-year cycle? So there's no, but to try and time it, you can't. You have to look, if you're thinking, oh, should I buy now because I'm retiring next year, or should I wait until 6 months? No, if you're retiring next year, then you shouldn't be in it. Put that money aside. The money you're thinking about trying to time the market with, well, that should be 10-year money. And then in that case, 10 years from now versus 10 years and 3 months, don't beat yourself up about it. You can't think that way.
Yeah.
So
yeah,
I think to combat, nobody likes inflation. I always say that nobody likes inflation. I haven't, when the market tanks, there are people that like that. People like that because they can bet against it. They can short the market. When the market goes up, people like that. A lot of people like tragedy, but I haven't met, what's the term? German term, Schadenfreude. I haven't met anyone that's like, yes, inflation. I love to see, maybe people in other countries like to see us with inflation, but I just saw Australia's markets got crushed when we got inflation numbers coming out. We're all connected here. So nobody likes it. Unless you have significant debt, maybe there is someone that might like inflation. But if it's a fixed rate, right? But to cannibalize your retirement, to pull from your retirement or stop sending it for your future self, that's not the way to combat inflation. You have to start thinking about increasing income, reducing expenses. But to cannibalize future, that's tough. It's not easy though. But you have to have a plan for inflation. So if you're saying here, Dan, well, that's great. I get paid a salary. I can't ask for a raise. Why not? Well, it's easier said than done. Fine. If you're not going to get a raise, okay, and you can't control inflation, what are you going to do? And a lot of people say, I'm working from home, saving money on gas, saving money on expenses of eating out with the lunch crowd. But now my company's making me come back to work. Okay. Well, so there are certain things that people did during the COVID pandemic that they may be able to carry over, but people are like, oh, I'm free again. And there's no real true solution here other than make sure you're factoring it in, because maybe you do have to work a little longer than expected. Maybe you're not going to retire at 62. Maybe it's going to be 64. Start planning for it, but at least have the conversation. I mean, the unknowns are what get people sick. They get nervous and stressed. Yeah. At least, and at least think about inflation and add it to your retirement plans.
Yeah, it's a tough topic.
That's inflation for you.
That's it. Is that Jack Nicholson?
Nicholson? No, I don't know who that is, but it fit. So I threw it out there, Dan. Well, yeah, we're all dealing with it, and it's affecting everyone right now. So I'm glad we talked about it, and people just need to plan for it, but not do drastic things like pull money out of their retirement accounts if they can.
I mean, you could do that. I mean, there's times when it's like, hey, do I take on some debt take some out of retirement to pay off debts? And it's a fine line. You have to thread that needle. And I have a feeling that this survey was really just talking about generalities, and people aren't threading needles. They're just like, where do I go?
Yeah.
Boom, retirement, right? It's the
exactly.
shiny object
and
on the shelf.
And they're not working with a financial services professional, a financial advisor like yourself to do the math and thread the needle. And that's what you do, because people don't understand everything they need to factor in. And so I encourage our listeners or viewers out there, if they're viewing this on the YouTubes, they need to give you a call. I know that you'll offer them a no charge consultation to go over this and help them figure out how they're going to make some adjustments to their retirement plans and their finances to deal with rising inflation, correct?
That's it. Yeah. I'll put the number up in a moment. And just remember, when you call the number, if you want to leave a message for Tony and I about this show, do extension 5. So thanks for a good show, Tony. Maybe next week, inflation will be lower. We'll see. Catch you then. Bye, everybody.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.